Hello, fellow investors. It's Iggy from the Investing Iguana. And today, I'm sharing how I'm handling a hot button topic. Singapore's big banks just dropped after the Fed cut rates, and everyone seems to be losing their minds. Are you thinking of selling, feeling worried, or just plain confused? You're not alone? In this video, I'll break down why I'm still confidently holding DBS, OCBC, and UOB, and give you the step-by-step framework that helps Singapore investors stay calm when everyone else is panicking. But hang on, why hear this from me? Just so you know, the Investing Iguana was ranked 8th on Tiger Broker's 2024 Influential Tigers list. Our community just crossed 1 million reads and 58,000 likes. I've made over 1,000 videos with 600,000 watch hours. And my whole focus is on turning market chaos into clear action for everyday investors in Singapore and across Asia. This episode is adapted from my latest Substack deep dive. And if you want all the details, charts, and checklists, you'll find the full written playbook on Substack. Link in the description below. So here's our roadmap for today. First, we'll replay the chaos, what happened right after the Fed rate cut, and how SG Bank shares reacted. Next, we'll weigh the real risks versus long-term power in these banks. We'll jump into what makes DBS, OCBC, and UOB truly different from banks overseas, including what MAS and CPF/SRS mean for your investment safety net. Then, I'll share my own balance framework, 5 rules that keep me steady. After that, some practical tactics, how to collect dividends, stagger your buys, and use CPF/SRS to your advantage. We'll wrap up with the top psychological traps to avoid, and close with real SG-flavored action steps that you can start using today. Let's get into it. Picture this. The Fed drops rates. Within hours, Singapore's big banks, DBS, OCBC, UOB, get hammered on the SGX. You check your phone. Red screens, lower dividend forecasts, and social media filled to the brim with sell now hot takes. If you got jitters, you're not weird. Here's the inside scoop. Singapore banks make a lot of money from something called net interest margins. That's the difference between what they charge for loans and what they pay to depositors. When US interest rates fall, the expectation is that SG banks will earn less. That's why prices fell. But here's the first big lesson. Short-term price drops, they're just noise. It's not the same thing as a fundamental problem with the bank's business model. Let's pause. Have you ever sold something just on a bad headline? Or regretted a panic buy? Stick around, because in a bit, I'll show you how to avoid those costly knee-jerk moves. Imagine you're driving and hit a pothole. Your car bounces, but it keeps rolling. That's what Fed rate cuts are for Singapore banks. An uncomfortable jolt, not a crash. Short term, yes. Lower rates mean banks earn less from lending. Dividend numbers may wobble. Traders jump in and out to chase news headlines. But here's what's rock solid. Singapore banks keep making steady profits, not just from loans, but also from wealth management and insurance. They're tightly regulated by MAS. Unlike risky international banks, DBS, OCBC, and UOB are built to weather storms. In my article, I show a table where NIMs slide down a bit after rate cuts, but those headline dividend yields, they're still healthy. Share prices may dip, but look under the hood, and you see fundamentals are holding strong. Ask yourself, do you want to react to every speed bump or keep your eye on the entire journey? Let's shine a spotlight on what makes our home banks special. Start with the basics. SG banks anchor most of their lending business right here. That means less exposure to the wild ups and downs you see in US or Europe. Our regulator, MAS, keeps bank risk in check with tough rules. CPF and SRS. These unique SG accounts let you buy and hold bank stocks with a focus on long-term compounding growth. And each bank has its own superpower. DBS wins on digital innovation, apps, cross-border banking, and a regional footprint stretching into China and India. UOB knows the SME and Southeast Asia game, capturing opportunities across the region with smart partnerships and digital onboarding. OCBC balances rock-solid local lending with leadership in wealth management and insurance through Bank of Singapore and Great Eastern. The data backs it up, too. SG banks have lower loan default rates and stronger capital buffers than most global banks. That means safer dividends and more stability for us. So imagine 3 friends taking on the market. DBS, the techie, UOB, the explorer, OCBC, the steady planner, each helping you grow your money with different strengths, but all rooted in Singapore's secure system. Now let's shift from theory to action. Here's my balanced framework that keeps me grounded when the market is noisy. I review fundamentals every quarter. Don't get caught off guard. Look at net interest margins, loan growth, new business, and regulatory updates. Don't overload on any one bank. I never put more than 25% of my portfolio in a single name. I stagger my buys. I add to my positions over time, not all at once, so I get better average prices and miss fewer dips. If I see red flags like dropping ROE or surprise losses, I slow down, check, and don't just react. And for peace of mind, some of my bank shares go into CPF and SRS accounts. That way, compounding does more of the work, and wild swings hurt less. Picture a pie chart. Banks are one slice among many, surrounded by REITs, blue chips, and global funds. That's how you keep the odds in your favor. Every quarter, every year, I stick to these checks, and it helps me ignore the drama. Here's how to play the game. Put dividends first. Look at the history, not just the forecasts. SG banks have been paying steadily, even when times are tough. Stagger your buys. Wait for dips. Never rush in after a spike. Collect pieces of your position slowly. This is how you avoid regrets. Let CPF/SRS take the stress. These accounts are great for holding and compounding through ups and downs. When dividends hit, reinvest them or add to your cash buffer for future buys. Let me show you how this works in real life. Take May, a local investor. She buys DBS, OCBC, UOB in small slices using her CPF/SRS and spreads the rest across REITs and global stocks. She never throws in all her cash at once. When she gets dividends, she puts them back to work. If social media turns bearish, she calmly reviews the numbers. She follows her own plan, not the crowd, and she sleeps easier as her nest egg quietly compounds. For all full charts and step-by-step checklists, remember to snag the full post on Substack. Here's where most investors stumble and how you can stay out of trouble. If you chase every headline, you'll end up buying high and selling low. If you panic and sell everything, you often lock in your losses just as prices are about to recover. If you let emotions rule, trading on every fear, you'll get worse results and higher stress. A 2025 SG survey showed most people who sold bank shares right after a big drop missed the rebound. Those who waited, checked the facts, and acted methodically ended up with better returns and fatter dividend yields. So ask yourself, who do you want to be? The stressed out trader or the cool, calm builder? Let's wrap with Iggy's 4 action cues. Keep your positions balanced. Spread your bets. Never overload one bank. Build with CPF/SRS for automatic, compounding growth and less worry about price swings. Think in years, not weeks. Let time and dividends do the heavy lifting. Don't focus on market noise. Tune out the headlines. Focus on facts, enjoy your life, and let your investments work quietly for you. If you want the printable checklist, grab it from Substack. The full framework and action plan are waiting for you. Here's my parting advice for every Singapore investor thinking about bank stocks right now. Consider holding DBS, OCBC, and UOB for their sturdy fundamentals and history of reliable dividends. Stagger your buys and never overweight any single thing. CPF and SRS accounts are your best friends here. Review on a schedule. Trust your process, not market moods. Patience and discipline always win in the long run. That's been my lesson as both analyst and ordinary investor in Singapore's unique market. So if you found this useful, like, subscribe, and hit the bell for more real talk that actually helps you grow. Drop your toughest investing questions in the comments. And if you want all the frameworks and examples I mentioned, tap the Substack link in the description. The membership community there is packed with smart, supportive Singapore investors just like you. Want more? Watch the video on dividend investing with CPF/SRS next. It's perfect for building on today's topic. See you in the next one. This is Iggy from the Investing Iguana. Stay calm, invest smart, and let's grow together.